So guys, can you hear me? Can you see the screen? Please respond and then we will start. Guys, can you see the screen and hear me? Guys,
Yes, sir.
yeah, okay. So yesterday we started investment appraisal. Okay. So we learned one method that is payback period. We learned. Okay. And also we are on the way to learn on another important, very important method of investment appraisal. So for before learning that, we need to understand what is time value of money. Okay. So as you know, this is the projection. This is a projection. We are standing at this point T0, T0, and we are planning to start a business at standing at this point. And we did our market research. So we are planning to start a T stall, and we did our market research, and we came to know that, and we need to invest. So initial, like starting any business, we need some investment, right? So initial investment is 600,000. Okay, and also based on our research, we are assuming it is not real figures. We are assuming that in the first year revenue will be this, cost will be this, all this, and finally we will make this much money. And similarly in the second year we will make this much money, third year this much, fourth year this much. Okay, so the initial investment is 600. So who is calculating this is father and the engineer son. So engineer son is not a finance guy. Based on his common sense, he is doing something. Okay, so who is calculating this is father, and engineer son is doing this calculation. So initial investment is 600,000, and also cash flow on initial investment is 600,000. Return phase cash flow, what is it? Return phase cash flow, return phase cash flow is first year they are making 200,000, second year 200,000, third year 400,000, and fourth year 300,000. So total what they make in 4 years is, so they are, and as of now they are assuming that they will run the business for 4 years, and they are making the calculation only based on that. So total return in 4 year what they cash flow they are making is 200 plus 200, 400, 400 plus 400, 800, 800 plus 300,000, 1100,000. Okay, 1100, that is 1.1 million. So they initial investment is this, return phase cash flow is this. Okay, and this engineer son is telling, so we invested 600,000 but we made 1100,000 in 4 years. 1100,000 means extra 500,000 they made extra 500,000. So this is not a financial analysis as per F1, nothing to do with that, but this engineer son made this calculation. Okay, so then evening the ACCA son, after work he came home and he saw this calculation what the engineer son have made. Okay, so now the engineer son have made this calculation. The ACC son is telling him, see what you have calculated. Okay, similar one method, analysis method is there in F1 what I have learned. So I will explain to you that. So what you have calculated, this investment phase cash flow, that is okay, 600,000. As of now we are investing 600,000. The present value is 600,000 only. But see, the return phase cash flow that what you have calculated in this comparison or this analysis is not acceptable, because this 200,000 what you are getting is after 1 year. This 200,000 what you are getting is after 2 years. This what you are getting is after 3 years. This is what after 4 years. See, you have to understand that the 10 rupees you get now and 10 rupees you get after 1 year, it is not the same. Maybe 10 with the 10 rupees now you can buy a tea. Maybe with the 10 rupees, that same 10 rupees, after 1 year you won't be able to buy a tea. So value of money always, yeah, okay. So value of money changes with the time. So after 3 years you are getting 100 rupees. It is not having that much purchasing capacity. With that money you can buy less as compared to now. Maybe now with 100 rupees you can buy 10 teas, okay, or 2 apples or whatever. Maybe with the same 100 rupees after 5 years you won't be able to buy 10 tea. Maybe that time, if suppose tea is costing 20 rupees, you won't be able to buy that much 10 teas. Maybe you won't be able to buy 2 apples. So depends, the value of money changes with the time. Okay. Okay. So okay, time value of money. If somebody have to give me 100 rupees now, 100 rupees now, I will take 100 rupees. But if that person is telling after 1 year he will give me 100 rupees, okay, 100 rupees. So I will tell him, if you are giving me after 1 year, you should give me 5% extra. 5% extra. So okay. So you should give me 5% extra. So that means if you are giving me money after 1 year you have to give me 100 into 1.05. 5% means 105 percentage you have to give me. 100 plus 5%, that is 105 percentage you have to give me. That is 105% means 105 divided by 100, that is equal to 1.05. okay. So 100 into 1.05 is equal to 105. If you are giving me after 2 years means you have to give me into again 1.05. Calculate and tell me guys, 105 into 1.05. That is 110.25. 110.25. And if you are giving me after in third year, after 3 years you are giving me means you have to give me again into 1.05. How I will find this 1.05, that is into 1.05.
115.76.
Okay, 115.76. So if in fourth year you are giving means again into 1.05.
115.
121, right? Okay. So now we know that I am telling that guy somebody have to give me 100 rupees. Now if you are giving means T0. Now you can give me 100. But if you are giving me in after 1 year, you have to give me 105. If you are giving me after 2 year means you have to give 110.25. If you are giving in third year, 115.76. If you are giving in fourth year, 121, you have to give me. So there are many factors for like what all things I can consider is if it is my brother, I will say like what is the inflation, what is the value, like purchasing capacity of the money will change and the value of the money, only that I will ask. If it is to a stranger means many things I will consider. See what, who knows he will give back the money or not, there is risk involved. This money I could have invested somewhere, I am losing that investing opportunity, and also the time value of the like, purchasing capacity of the money changes by time. So all this I will consider. If as it is my brother or non person, I am asking 5% return. Okay, 5% return only I have. If it is a stranger, I would have definitely asked 18% return I want. 18% return I want. Okay. So 18% I will ask. So as of now, we are calculating based on 5%. Okay. So same calculation, same calculation. Suppose T0 rate of interest return required is 5% only. T0 value we don't know. T1 value we don't know. T2 value we don't know. T3 value also we don't know. T4 value we know, that is 121. Okay. So after 4 year, somebody is telling after 4 year or after 4 year, like suppose I will get after 4 years I will get 121 rupees. So I want to find out what is the value of that one. Like rate of return is 5%, or the discount rate what we will be using is 5%. So what is the value of that 121 in T0, that is now, and also the value of 121 in second year. You find out and tell me. Okay, T0 and T2, what will be the value, you have to tell me.
Sir, T2 it will be 110.25.
Okay. Okay. T1.
Sir, 100.
T0 100. Yeah, same. So the rule is from here to, from present value you know, future value you have to find means directly you have to multiply by 1.05. Backward you have to calculate means you have to divide. So how I calculate is 121 divided by 1.05 will give you T3 value. 121 divided by 1.05 will give you 100 and tell me 121 divided by 1.05 how much it is? 115.76. Again,
76.
yeah, again it divided by 1.05.
110.25.
Yeah, again divided by 1.05. 105. Again divided by 1.05. Okay. So the rule is, what you have to understand is, if now again another example I am giving, T0 value is 200. Okay, don't start calculating, I will tell you, then only you have to get T1, T2, T3, T4. 5% is the interest rate. Okay, how you will calculate is 200 into, directly you can, from here directly you can calculate what is the T4 value. How you will calculate is 200 into how many times 1, 2, 3, 4 times. T4 value at 4 times you have to multiply to 1.05. That is 1.05 the whole raised to 4. You will get the directly T4 value. Same thing happening here, right? This 100 I have to find, this means 121. T4 value means 100 into this 1.05, 1.05, this 1.05, 1.05, this 1.05 into 1.05, this 1.05 into 1.05. That is equal to 100 into 1.05 the whole raised to 4. Will give you the T4 value. So nothing but 5 percentage means 1.05 you have to take. How many years means that raised to that number of years. You will get the value. Similarly, similarly, so I will get what will be the value I will be getting? Tell me the answer, guys.
255.25. 26.
255.26. 255.26. Okay. Similarly, just a minute, guys. Yes, guys, we will continue. Yeah. Okay. So now in another situation, you know that you are given that 5 percentage is the discount rate. T0 value you have to find out. Okay. And T4 value is given. T4 value is given. That is 255.26. How you will find this? Directly what you have to do is from here to here you have to find. Okay. You have to find the T0 value. How you will find is 255 divided by 255.26 divided by 1.05 the whole raised to 4 you have to do. Calculate and tell me whether you are getting 200. Getting 200?
So that value is 244.
244, okay.
Yes,
Yeah,
sir. It was my mistake. Yeah.
Yeah, no issue. 244 point
44 only, sir.
244, okay. 244. Okay, 244. So now you will get 244 divided by 1.05 the whole raised to 4.
Yes, sir, it's coming 200.
Okay. Okay. So it is 200. So now you know after 4 years you are getting 244 and the discount rate is 5 percentage. What is the value I should consider? I will consider only it as 200. So this is what the ACCA son is trying to explain to this engineer guy. See, after 4 year you are getting 244 and the discount rate what we have to use is 5 percentage. Then I will consider it as only 200. But now you understand the time value of money. So now this ACCA son is telling this engineer son, see this 200 also you have to find. After 1 year you are getting this much. You have to find the present value of this. After 2 year you are getting this much. You have to find the present value of this. After 3 years you are getting this much. These and all are assumed figures. Okay, we are standing at this point and we are making a business plan and we are assuming that T1 figures will be like this, revenue will be this, cost will be this, and what we will get is this much, and T2 this much we will make money, this much money we will make, T3 this much money we will make, and so now we are making the investment appraisal. So we know how much money present value we will be investing. Now currently what is the money we will be investing? Initial investment required is 600,000, we already know. So, and what is the return phase cash flow that the engineer guy have calculated is 200 plus 200 plus 400 plus 300. Now the ACC son is telling similar type of analysis. The engineer son doesn't know any financial analysis, nothing. So ACC son came and he is telling this type of analysis is there, I have learned in F1. So I will explain to you. So for that you need to know time value of money. So now by this you know how to make the calculation to adjust for the time value of money. Okay, from this you know. Now we will apply the same logic in this question. Okay, so now we will erase what all things. Now you don't have to consider this thing. Okay, what the engineer son have done, just leave it. Okay, now ACC son is making some calculation. Now
Sir, like he will find out the present value of this 2 lakh, 2 lakh, 4 lakh, and
yes,
3 lakh,
yes,
no?
yes, everything present value only we will compare. That's it. Actually, this method is the core and the toughest or mostly used method in investment appraisal, and this complicated models of this method. The logic is this is tested heavily in AFM also. Okay, in FM also this is the core one of the investment appraisal method, and before me teaching only you are getting right. So that's it. So what I took the effort for through this example, it is you are getting it. I'm happy. Thanks. Okay. So now,
Yeah, worth it, na?
yeah. So initial investment is 600,000. Okay, and the present value of initial investment is 600,000. That is now itself we are spending that present value is 600,000 only. Now the present value of return phase cash flow we have to find out. So first we have to find out the present value of this 200. So it is after 1 year we are getting, and the rate of return what we have to use is the cost of capital of the company. What is cost of capital of the company? In the initial example I taught you, one more time we are going. So cost of the rate what we will be using is, see, the initial investment of 600,000, this family didn't have money. Okay, family didn't have money, initial investment they didn't have money to spend. So what they did is they only had 300,000. So the company have to raise 600,000 to start the business. That is about the company, this chai company. Okay, and 300,000 of the capital came from this family who are the founders, father, mother, this ACC son, engineer son. They put their own money. So 300,000 was, they raised equity. The family only put the 300,000. Okay, 300,000. Okay, now again 600,000 is required, again 300,000 required. So what they did is they took some money from their family friend. Okay, so that is also equity only. This company is raising equity from some other external party. So that is also the family friend of this family. Okay, I will put it as external equity raised from external parties. So the first is the equity raised put by the invested by the promoters. So in the corporate world, like what we tell is equity holding by the promoters. I will put it as, instead of family, I will put it as promoters or hyphen promoters. Okay, and so the external party, that is family friend, they put 150,000. Family friend. Okay, 150,000. So now 300,000 plus 150,000, 450,000 they have raised. Again money record, 600,000 is the money record actually. So what they couldn't raise any equity more. So what they did is they went to a bank. They went for a bank loan. That is 150,000. They took a bank loan. Okay. 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 So 150,000 bank loan they did. So they raised capital through equity, their own money 300,000, family friend external equity 150,000, and bank loan 15,000. And the bank loan interest rate is 13%. Bank want interest rate of 13%. That means this company have to pay. Capital doesn't come at a free. Capital somebody is giving. See, bank is giving us money. Bank is giving us loan for 3 years. Means 3 years the bank is not losing the opportunity to invest somewhere else. So pakka 100% bank will want some return. So bank charges interest from us, and that 13% we have to pay the bank. Okay. And similarly, external, this family friend, he is telling, see, my money I am investing in your business. I could have invested in mutual fund or shares or some other FD I could have put, and I could have got some return. And here I am investing in a new business and some risk is also there. I want 18% return. This family friend is telling. So for him 18% return wanted. Okay. And this family, their own money also, it is valuable, right? They are putting their money, even though they are the promoters. When it comes to money, if I am putting, they are putting their money, they also want 18% return. They are also taking the risk. Okay, so overall 600,000 capital raised through these three ways, and the rate of return required is this much. Okay, now we have to take the average of this 18 percentage, 18 percentage and 13%. What is the average? That we have to find out. Now don't think about how I calculated average, but because separately we will learn about this calculation separately in cost of capital. As of now, just for understanding purpose, I am going through this. But this calculation you don't have to study. As of now, you are understanding, no issue. Otherwise, I won't calculate the real average. Average calculation I am not going. But assume that the average cost of capital. So the cost of capital of this chai company. Suppose assume that this cost of capital of this chai company, the average of this 18 percentage, 18 percentage, and 13 percentage is, assume that it is 16 percentage. Okay, 16 percentage. So now you know that the capital raised by us is 16%. The cost of capital of this company is 16 percentage. So what we will do is, while calculating the present value, so here we used 5 percentage, right? 5 percentage, 5 percentage. So instead of 5 percentage, when we are calculating the present value, so we have to calculate now. T1, T2, T3, these figures we have to calculate. So we will be using the rate, what we will be using is 16 percentage. Okay, 16 percentage. So now we will calculate the present value of this T1. After 1 year I am getting, they are getting 200,000. I will find the find the present value of this 200,000. So separately we have to find each of the present values. Can anyone calculate what will be the present value of this 200,000? After 1 year we are getting this 200,000, and the rate you have to use is 16 percentage. So anyone try to calculate what will be the present value of this 200,000 after 1 year we are getting. That means T0 we have to find, T1 we are getting 200,000, 172. Okay, the rate we have to use is 16 percentage, 172, right? So I will also calculate
Yes.
here, equal to this divided by 1.16 the whole rise to 1. In Excel how we will do is like this, 172,413 is the answer. So when we are doing the, like, after learning this method, we will be doing one full-fledged exam level question. That time, along with me, you all guys will open an Excel sheet and you will be doing along with me. Okay. See, whenever we are learning, this is general. This is something what I want to know. Whenever we are learning, okay, by reading, when you are studying, by reading you will get 10 to 15 percentage will go inside your brain. Okay. And when you are watching some video, if you are watching some video and hearing the audio, some greater percentage, 20 to 30 percentage, it will go in your mind. Okay. And when you are actually practicing, 50-60 percentage will. Practicing means, now next question, when we are practicing you have to practice along with me. So actually you are doing. So 50-60 percentage it will go in your brain. Okay. And when you are actually teaching, how I am teaching you, so teaching, if you are teaching means more will go inside your brain. Okay. So this is how our brain works. If you are reading, nothing will go inside your brain. It's the worst thing to do. Okay. Reading is okay, some level of reading you have to do, but limited. Then again, next step you have to do is start practicing here. Whatever you are going through some question, practicing means many, like, heavily it is going inside, like your brain is absorbing like anything. And if you have the opportunity to teach, then go and teach. Maybe teaching, you don't have the students to teach, go you tell your brother, like, from financial management, this investment appraisal, I'm starting a business, I have to do this, do that, like someone you will get na, if they are interested, you go and teach. So that is also teaching. You will also, your brain also, this concept will be strong. Okay. So always remember that. So because of that, when we are doing the actual question, you all guys will also be practicing along with me. You guys will open an Excel sheet and you will be doing. Okay, so as of now, we'll come to our question. So it is 172, right? How I calculated, you can see 200,000, that is D27 divided by 1.16% is the rate you have to do. 1.16 the whole raised to 1, because after 1 year we are getting 172 413 is the answer. Everyone got? Everyone got? Everyone got? Okay, now calculate for T2 what is the value. This Excel sheet I will be sharing with you. Okay, this Excel sheet what we are practicing in the class I will be sharing with you. So T2 after 2 year we are getting 200,000. What is the value, present value of that? That means T0 we have to find, T1, T2. T2 we are getting 200,000. The rate we have to use is 16%. Tell me the answer, guys. T2, what is the value?
Sir, it's 148633.
148633, right? Let us calculate. So equal to this 200,000 divided by 1.16 the whole rise to second year, right? After 2 year we are getting, so 2. Yes, 148, yeah, correct only. So similarly T3 and T4 we have to calculate. T3, so T1, T2, T3 we are getting 400,000. Find the value at T0, that is present value we have to find at 16%. Calculate and tell me, guys.
Sir, it's 256263.
256263. Okay, let us calculate. Equal to this divided by 1.166 the whole rise to 3. 256 263. Okay, so similarly T4 value 300,000. Calculate.
Sir, it's 165687.
Okay, so this divided by 1.16 the whole rise to 4. 165 687. Okay, so now you know what is the, after 1 year we are getting 200,000, but I will, ACC Sun is calculated this, but I will consider it as only 172 413. And second year again we are getting 200,000, but after 2 years we are getting, so this I will consider it as 148 632 only. So first year if I am getting, I will consider it as 172. After 2 year I am getting 200, same 200,000 means I will consider it as 148 632 as of now. Okay, similarly 400,000 I will consider it as this, and T4 cash flow what I will make after 4 year I will consider 165 687. Okay, okay, so now you know present value of initial investment. Present value of initial investment is 600,000 only. That is the initial investment. Okay, and the present value of investment, I will put it investment cash flow. Present value of investment return phase cash flow. Present value of return phase cash flow. Returns means this cash flows present value equal to sum of this from here to first year cash flow, second year, third year, fourth year what we made. So now you know initial investment is this and returns is this. So how much extra NPV? That is called a net present value. Present value of initial investment is this. Present value of return is this. So net present value is equal to so NPV is this. So there is a method called NPV method, and now the NPV is this. NPV is 142,997. 142,997. So see, what it means is we raised capital from these three sources, okay, and they wanted a return of 18 percentage, 18 percentage, and 13 percentage. So when we are taking this present value means we are adjusting for giving them a return. After giving them a return, I have a generated a wealth of 142,997. The company have generated even after paying for the capital providers. Capital providers wanted some money return. So I have given them that return, and even after giving them that return, again some positive is there. Suppose this present value, suppose this present value of cash flow, when we calculated the present value, it was 600,000. 600. That means NPV will be 0. NPV will be 0, right? Then also what it means is we have done the business and we were able to provide this much return to each of the shareholders, like equity holders. We were able to provide 18% return, and for the bank we have paid 13% return, and after that nothing is remaining. So company have raised capital, and whatever is the cost of capital we have paid, and after that nothing is remaining. That doesn't mean this project is not, this chai business is not making any profit. They are making profit, and with that profit they have given 18% return to equity holders and 13% interest we have paid to the bank loan, and after that nothing is remaining. If present value of return phase was also 600,000, but actually here it is not the case. Present value of return phase is 742,997. Actually what it means is, so, and the NPV is this one. This method is called NPV method. Okay, this method is called NPV method. So NPV is 142,997. What it means is, even after providing a return of 18% to equity holders and 13% return to the bank, we are making again, even after paying them, we are having some extra. So that is what NPV method calculates. Okay, so this is now ACCA Sun is telling, when engineer Sun calculation he saw, ACCA Sun was telling, see, what you have calculated is correct, but we have to adjust the cash flows we will receive after 1 year, 2 year for the present time value of money. And there is a method called NPV analysis. Some analysis method is there, NPV analysis. So I will explain to you that. And for that, this ACCA Sun taught engineer Sun the time value of money and also this calculation. Okay. So now you know what is a NPV method. Okay. So now we have to do one NPV level question. NPV question, one exam level question is there that we have to practice. So that we will practice after the break. Now it is 8:49. Till 9:05 we are having the break. 9:05 you have to be back. 9:05 you have to be back, and we will practice on exam level NPV question. We will practice. Okay. So break till 9:05. Okay, guys. Before that, any doubt on this, guys? Ask me like, what is your understanding? So when we are doing the question, some more clarity you will get. So as of now, any doubts on this? Guys?
No, sir.
Okay. So even if you have some full clarity is not there, something, when we are doing more questions, you will get more clarity. Okay. So this is only the starting. I have put you through this thing. The if you are like one more thing you have to keep in mind is, whenever you are always, not in this paper, every paper you have to keep in mind, whenever you feel something you are struggling, then you should be happy. Why? Because you are learning something new, you are developing, you are growing. That is why you are finding it difficult. It is easy means already you have that level, and you are doing something below that, below your level, so that means you are not growing. If you find something difficult, challenging, then you should be happy because you are growing, you are learning, you are developing some skill. Okay, so that you should be happy. Okay, so break till 9, yeah, 9:05, 9:07, break. Yeah. Yes, guys, we'll start. So this is NPV method, okay. So now we are going to do a exam level big question. Okay, so you guys can read this question. Can see the screen? You can read?
Yes, sir.
Yeah, you can read this question.
Sir, reading part done.
Reading part done. Okay. Okay. So Hepaco is preparing to launch a new product. So what these informations are what information you see here? See, in the case of our chai business, you know that they went to the nearby area. They spoke with different people who are doing chai business, and also online research they did, and they gathered all the information. Okay, gathered all the. So whatever information you see here, consider it as the information gathered by our research. This is about another business. Okay, so we are going to do the NPV analysis. Calculate the requirement is calculate the net present value of the investment project in nominal terms and comment on the financial result. Okay, so we have to calculate the NPV of this project, and it is a some business somebody wants to start, and what is the market research, what is the data available. There, in the case of chai business, they collected from the market, Google search, and then they brought it and they put it in Excel format, that projection they made. So here somebody else business, their market research information is given here. That is what you see in this question. The body of the question is that only. And based on this information, you need to make a projection. Projection is nothing but what you see here. Here in the case of chai business, this is the projection. What will be the cash flow, inflow and outflow in the year 1, year 2, year 3, year 4. Okay, this is a simple example for understanding purpose, but here it will more information will be there, more information is given. Okay, so Hepaco is preparing to launch a new product in a new market which is outside its current business operation. So they are planning to start a new product in a new market. The company have undertaken market research and test marketing at a cost of 500,000. Okay, so they have done some market research, and for that also they incurred some expense. But see, in the case of chai business, they went to the nearby area, they have to travel, they have to speak with different chai business owners. But that already, if they are starting the business or not starting the business, that cost is already incurred. They have run. Similarly, here they incurred some expense for market research. But irrespective of whether they are starting this business or not, that expense is already done. So we won't bring this 500,000 anywhere in our calculation. Okay, this it sounds logical. In the case of chai business also, in this projection, we didn't bring anything relating to market research expense. Like when they went to nearby town, they have to travel, they have to stay somewhere, so expenses are there, right? And when they are meeting some business owners, if they are meeting in some cafe, they have to pay for the bill also they have to pay. So that is already done, and that we won't consider while appraising the project. It have nothing to do actually directly with the project. Okay, so here also we won't consider this 500,000. As a result, we expect the new product to be successful. Hebac plans to charge a lower selling price initially and then increase the selling price on the assumption that the new product will establish itself in the market. Okay, they are telling their story, whatever story they want to tell, they are telling. We will take figures. Forecast sales volume, selling price, and variable cost are given. Okay, selling price is given. So from this, we know. See, selling price per unit is given. So from this we will be able to bring the first line item, that is the revenue. What will be the revenue generated in first year? That is like number of units sold is 200,000. So selling price is 15. So 200,000 into 15 will give you the revenue. And similarly, each of the year it is given. And variable cost. Okay, cost information also they are given. $9 per unit. So number of units into $9 will give you what is the cost in year, variable cost in year 1. Similarly, other years also. Selling price and variable cost are given here in current price terms before taking account of forecast selling price inflation of 4% per year. Oh, one thing they are telling is this selling price. See, now currently the selling price is 15, and maybe because in next year they have to increase the selling price because of inflation. What is the inflation? The current price term is 15. Okay, so all the second year also the price selling price what they have given here is 18, but this is in current price term. As of now we are telling it is 18, but at that exactly at that particular time because of inflation some adjustment we have to do, so it will increase by 4%. So all these figures what they are telling is selling price in year 1, year 2, year 3, year 4, everything they are assuming based on the current situation. They have not included the inflation, so we have to include that inflation. When we calculate, it is simple, you will understand. And similarly variable cost inflation is 5%, and fixed cost also they are telling fixed cost is 500,000 per year in current price terms and would rise as a result of producing new product. Fixed cost inflation of 5%. So fixed cost every year there is also a cost, fixed cost of 500,000, and that will also increase 8% per annum. Okay, so now what they are telling, initial investment cost of production equipment for the new product will be 2.5 million. So also we know what is the initial investment required, payable at the start of the first year of operation. Production will cease at the end of 4 years because the new product is expected to have become obsolete due to new technology. Okay, so what they are telling is production will cease at the end of 4 years. They are assuming that at the end of 4 years they have to wind up this project because uh, new product is expected to have become obsolete due to because of new technology coming in. Our this product, particular product which they have started, it will become obsolete. So they are expecting that only 4 years they will be running this project. The production equipment would have a scrap value at the end of 4 years of 125,000 in the future value terms. Okay, production equipment, this 2.5 million they used for buying the equipment, and the end of 4 years they will get back this 125,000. So by what is the item lying in the production equipment, they will sell it as scrap. That time they will get 125,000, some money they will get while winding up 4th year end. Okay, so investment in working capital of 1.5 million will be required at the start of the first year of operation. So investment in working capital, so also they are telling they want the initial investment is 2.5 million, and also investment working capital also they have to put some money, that is 1.5 million will be required at the start of the first year of operation. Working capital inflation of 6% per year is expected, and working capital will be recovered in full at the end of 4 years. Okay, so these are the information given. Now tax information is also given, but let us start, then as time comes we will explain it in more detail. Okay, all of you open an Excel sheet, all of you open an Excel sheet. Excel sheet opened up. All of you opened Excel sheet?
Yes, sir.
Yeah.
Yes, sir.
Okay. So Excel sheet you have to the file name should be investment appraisal. Okay, so investment appraisal we will be keeping a separate Excel sheet, and similarly for other topic areas also we will be keeping separate Excel sheet. So as of now you can save it as investment appraisal. Now we are doing the Hebac question. Okay, so now we know that the this project is for 4 years. So now you have to make the format T0, T1, T2, T3, T4. Okay, all of you create a format like this. And now first line item always will be revenue. Okay, so we know that selling price is 15. Okay, so first sales volume is given, so we will bring in the sales volume here. Okay, just put in for the convenience sales volume, just we will put it in the, it's not a line item but just for our convenience we are putting it here. Okay, sales volume, sales volume is given in the question. First year it is 200,000, 800,000, 900,000, 400,000. Guys, I will be sharing a drive link with you. There you will be able to open this question there itself. Okay, so let me put that in drive and you will be able to open. Guys, in the chat box, Tilak, I am not audible. Tilak, can you hear me, Tilak?
Sir, you are audible right now. Like it
Yeah,
was
yeah,
starting of the
okay.
class, it was.
Yeah, yeah, okay, okay. So in this drive, you can download that question. Drive link is in the chat. So you can also open. Opened question you were able to open?
Yes, sir.
Okay. So sales volume, bring it here. Bring it in the question. In first year, 200,000. 800,000, 900,000, 400,000. 800,000. Okay. Just for convenience, I brought it here. Okay. Now the first line item always will be sales revenue. Sales revenue. Okay. Based on this, first year sales revenue will be how much? How much? Tell me, guys. Tell me, guys. Based on this question, first year sales revenue will be how much?
So first, like we have to multiply this by 4%, like increase the sales selling price per unit.
Yeah, yeah, yeah. 15 into 4% you have to increase the selling price.
So 31 lakh 20,000.
31, 11, 20,000. Hmm. Okay, one thing we will do is we will round off these two three places. Okay, so 200 means here we will put only 200. Okay, so we'll do, okay, sales revenue is equal to, you know that selling price is 15. Okay, selling price is 15, but it is in current price time. So every year inflation is there. So first year we have to inflate it for 1 year. So it is given selling price and variable cost are given here in current price term before taking account of forecast selling price inflation of 4%. So selling price is getting inflated at a rate of 4 years, 4%. So we have to inflate the selling price 15 into 1.04, we have to do 1.04, that is 4%, we are increasing it. The shortcut is 1.04 into, so equal to 15 into 1.04. Okay, type, you also type in your sheet 15 into 1.04. So now what you get is the exact, now T1 first year what is the actual selling price, you will get 15 into 1.04 into, now the selling price you got, into the number of units, number of unit is 200, you will get the sales revenue for T1, that is 3120. You can see the formula here. After completing T1 sales revenue 3120, if once you get, tell me. Okay, type in the chat 3120, type in the chat 3120. As it is a first question, we are going very slow. Okay, type in the chat 3120. Guys, once after getting 3120, type in the chat. Or you guys want me to show again, tell me. Yeah, others got 3120. One more time I am showing, is equal to, see in the question, you know the sales price is 15 and we have to inflate, this is in current price term. Every year selling price will increase because of inflation. The inflation rate is 4%. So for 1 year we have to increase the sales price by 4%. So that is 15 into 1.04 equal to 15 into 1.04. This 15 into 4% inflation rate 1.04, you will get the actual selling price into number of units. Number of unit is 200. We have rounded it 3 places. Okay, so answer is 3120. Guys, others also please type in the chat, then only we can continue. Others, those who have done, type in the chat 3120. I hope like everyone is working from your, like watching from your system only, right? Or anyone watching from mobile, make sure like next time onwards you are able to, yeah, okay, thanks. So similarly, T2, what is the sales revenue? Equal to T2, we are telling in current price term the selling price is 18. So 18 into, we have to inflate it at 4% for 2 years, second year, right? So is equal to 18 into 1.04 the whole raised to 2. Now you will get the selling price. Okay, now you got the selling price into, now you got the selling price. I will put everything in the bracket. Okay, so now what you got is the selling price for second year into 800 will give you the sales revenue for second year, that is 15575. Completed. 18 into 1.04 the whole raised to 2 will give you the selling price for second year into 800 number of units. Type in the chat 11155575 after completing. Okay. So similarly, third year is equal to 22, 22, and we have to inflate it 22 into 1.04 the whole raised to 3 into 900 is equal to 22 into 1.0 1.04 the whole raised to 3 into 900 22272. Complete this line item, guys. Similarly, fourth year revenue will be 22 into 1.04 the whole raised to 4 into number of units. So is equal to 22 into 1.04 the whole raised to 4 into this 400 10294. So once after completing this line item, type in the chat line item. Type in the chat completed. Okay. Once after completing this line item, type in the chat completed. Three completed guy came. Okay. Okay. Now we have second line item. We will go to the question. Variable cost. Variable cost also same like that. Variable cost per unit is 9 and the number of unit is 200. And the variable cost inflation is 5%. Okay. So only one difference is revenue is the money what we get. It is adding up. And the variable cost is a cost. It is a money going away from us. Okay. So that is only difference. So anyway, we calculation is same. 9 into inflation is 5% into 200 units. We will give you the total variable cost. So variable cost. Variable cost equal to 9 units. 9, so 9 per unit. 9 into 5% inflation. So it's equal to 9 into 1.05 into 200 units. So complete this T1 value, you find out 1890. After completing this, type in the chat 1890. 9 into 1.05 into 200 units. Don't do T2 after completing 1890. Tell me, okay? 1890. Tell me. Once you get 1890, tell me. got on 890. Yeah, okay. So only one difference what you have to do understand is, this is revenue, this is the money that came to us, what we got, inflow, cash inflow, but cost is a cash outflow, so it should always come in minus. So we will put an extra minus. Okay, we will put an extra minus so that the overall answer is in negative. Okay, so it is an outflow, it should come in negative. That's it. So similarly you can complete the T2, T3, T4 is equal to 9 into inflation multiplied by unit. 9 into 1.05 the whole raised to 2 equal to 9 into 1.05 the whole raised to 2 into number of units is equal to 9 or 9 into 1.05 the whole raised to 3 into number of units. Everywhere extra one minus you have to put, because it is a cash outflow, it should come in minus. Once after completing variable cost line item, tell me variable cost. Once after completing this line item, tell me variable cost. Guys, you remember my name? What is my name? Guys,
Atul, sir.
yeah. Okay. Last time it happened when in the first class I will tell my name, who I am, all these things. I won't tell. Last time, like almost in the revision, and when were doing the mock, one student asked me, "Sir, what is your name?" That is after that I started putting this here name here. So he was asking, "What is your name, sir? What is your, like about me?" He was asking. He was not there in the first class, maybe. Yeah, that is why I asked. Variable cost line item completed. Yeah. Okay. So variable cost done. Now fixed cost. Incremental fixed cost of 500,000 per year is in current price term would rise as a result of producing the new product. Fixed cost inflation of 8% per year expected. Okay. So fixed cost. Fixed cost is 500,000. So is equal to 500 into, rounded off to three places. Okay, 500 into 1.05. Sorry, 8% inflation. Okay, fixed cost is
8%, yeah.
8%. Yeah, so 1.08. Complete the fixed cost line item and type FC. Completed fixed cost FC. Others complete. FC others complete FC fixed cost. I'm waiting for others. Only one FC I could see. FC done. Okay. Okay. Now we will go to the question. The initial investment cost of production equipment for the new product will be 2.5 million. The initial investment cost. So they are telling initial investment is 2.5, and also in that line item itself they are telling that 2.5 million they are using for buying the production equipment. The initial investment cost of production equipment for the new product will be 2.5 million, payable at the start of the first year of operation. Production will cease at the end of 4 years because the new product is expected to have become obsolete due to new technology. And also we are getting the information that this business they will be continuing for 4 years only, because after that, because of new technology, this product will become obsolete. So only for 4 years. And also we get the information the production equipment would have a scrap value at the end of 4 years of $125,000 in future value terms. Okay, so as of now this paragraph, let it be there, we will come to it. Now read further. So we will note it down. The initial investment is 2.5 million. So I will note it here. Initial investment. So initial investment for what? Production equipment. Initial investment is fully on production equipment. Okay. So that is 2500. Rounded off, we are rounding it at 3 places, right? So 2.5 million is 2500. And also we know that investment in working capital of 1.5 million will be required at the start of the first year of operation. So investment in working capital 1.5 million will be required at the start of the first year of operation. Working capital inflation of 6% per year is expected, and working capital will be recovered in full at the end of 4 years. So initial investment 2.5 million for buying the new equipment, and also they have to invest in working capital also, that is 1.5 million. So in the introduction itself I tried to tell you what is working capital separate. This is a separate syllabus area, but that term is coming in this investment appraisal. It is not the working capital, separate syllabus areas there, we have to learn a lot. So As of now, what is working capital? What is working capital? Remember? Anyone remember? Guys, tell me what is working capital? Any don't remember? Huh? Working capital is the capital required for day-to-day operation. So in the case of chai business, day-to-day they have to buy milk, they have to buy this, they have to give the some payment. Like previously they have purchased something and they have to make some payment, and also they have to make credit sale. Like somebody is buying from us and they are not giving us now. So 5 days credit we are giving. So for all this, some fund is required. In the business day-to-day operation also some fund is required. People are taking credit from us means we are buying milk, we are buying tea powder, we are making tea and we are selling, but we are not getting cash from them. After 10 days they will give. So that period the money is blocked, right? Whenever we are giving credit to someone, that money is blocked. We once we get money from them only, we can use it to buy milk, sugar, tea or other things. So whenever somebody is taking credit from us, our money is getting blocked in the business day to day. So many things are there. Even when we are buying this inventory, that also money is getting blocked, because we are buying sugar, tea for 1 to 2 3 weeks. We are buying in bulk and we are keeping it in our store. So money is blocked in inventory, and we are giving credit to somebody. Our money is blocked. Like after 1 week only, that guy will give us. You have bought tea from us, drank like to snacks from us. They are not paying. After 1 week, they will pay. So money is getting blocked there. So because of that, for day-to-day operation also we want some capital. So working capital is a capital required for day-to-day operation. So investment in working, like two types of, like initially they have to spend money on equipment, that is 2.5 million, and also investment in working capital of 1.5 million will be required at the start of the first year of operation. Okay, working capital inflation of 6% per year is expected and working capital will be recovered in full. Okay, okay. So here one term you have to keep in mind is investment in working capital of 1.5 million will be required at the start of the first year of operation. So that means it will come in T0. They are telling start of the first year of operation. So T1 means first year. T1 means first year. They are telling before the start of the operation, or before the start of the at the start of the first year, or before the starting of the project, or at the start of the first year, we wanted to have a investment in working capital of 1.5 million. So that means we will put some line. So here some things will come. So I am putting it down. Okay, working capital 1500, that is 1.5 million. So one more time I am reading it. Listen carefully. Investment in working capital 1.5 million will be required at the start of the first year of operation. It is not in the first year, but at the start of the first year of operation. That means we will put it in T0. Okay, T0 we will put it. And also investment in a production equipment, that is 2.5 million. That also we will put it here. Okay, initial investment, that is 2500. 2500. Okay, this we will put it in format will. Okay, so now we have this much information, and also complete till here, guys. Complete till here, then we will proceed. Complete the format till here, then we will proceed.
Sir, you have forgotten to put a negative sign on the fixed cost.
Yeah, correct. Thanks. Yeah. So complete till working capital and tell me you have completed this format. Make the format like this. Completed this format. After completing, type in the chat format. One more thing, initial investment is also an outflow. Whatever cash we have, we are investing. So that also we have to put in minus. Okay, minus. Working capital also we are investing. Money is going out. So minus. Okay. After completing this, type in the chat format. Format. One more format, two more format should come. All of you complete. Okay. So now also they are telling working capital inflation of 6% per year is expected, and working capital will be recovered in full at the end of 4 years. So this working capital, actually it is little complication is there, but for that practically you should think. Okay, suppose in our tea shop we are having a working capital of 50,000, or keep it as 10,000. Okay, 10,000. 10,000 is the working capital. We have invested 10,000 in working capital. Okay. So because of inflation, next year they are telling we have to maintain a working capital of 10% extra we have to maintain. So that means how much we have to maintain? One more time I'm asking. Okay. Leave about this question. Don't, I'm not asking about this question. I'm not asking about this question. In our tea stall, we wanted a working capital of 10,000. First year we had a working capital of 10,000. Okay. And they are telling that second year onwards, because of inflation, we have to increase our working capital. 10% we have to put extra. So second year, what will be the working capital? What we will be maintaining? Tell me, guys. 10% extra. Guys, tell me. Like, yeah, in the chat, tell me, guys. 10,000 is the working capital in the tea business for day-to-day operation. In the shop itself, they will inside their shelf they will be keeping 10,000, and from that they will be using for buying inventory and all those day-to-day activity. They will be using this 10,000, and they are telling second year, first year 10,000 was the working capital they were maintaining. Second year they have to increase the working capital due to inflation. They have to maintain a working capital 10% you have to increase. What will be the working capital in the second year? Tell me. Simple now, very simple only. Like I just wanted you to tell. Simple only, 10%. T1 the working capital is this much. So T2 what will be the working capital? Hey guys, why are you not telling? All of you are there? Garima, Kavya, Tilak, Kesar.
Yeah.
Yeah. So how much working capital we have to maintain? 10% extra here, 11,000. 10% of 10,000 is
Yes, sir. 11,000.
11,000 we have to maintain. Simple question only I asked. You thought maybe you complicated, you think more than what is required. 11,000. 11,000. Okay. That means already we have invested 10,000 on working capital. That is there. Second year we want 11,000 working, already 10 is there, so extra 1,000 we have to put in. So unlike here it is not, we have to put extra 10 percentage, that is 11,000 you don't have to put in second year, but extra what is required, already 10,000 we are maintaining, invested already 10,000, so second year 11,000 is what we require, so that means extra what is required, that only we have to increase. Okay, so okay, as of now we will stop here. We will complete the question tomorrow. Hey guys, one thing I wanted to ask, see our questions in FM and all, it's like mostly big questions and small questions, big questions, everything is there. So 2 hours slot means it is not working, I feel. So anybody who wants to have 3 hour, like I, for me anything is fine. So if 3 hours into, now we have in a week 2 3 classes, right? So is it better for you if we have 3 hours class, 2 classes in a week will be there, 3 hours, but the classes will be of 3 hours. So the timing can be 7 to 8, 7, 8, 9, 10, 7 to 10. So we will have a little bigger break and all we can have, but classes will be 7 to 10, 2 classes in a week. Instead of 3 classes, now 2 hours into 3 classes, we will have 3 hours into 2 classes. So anybody who is interested or wants, like whichever is best for you, you can, like both will work actually, finally at the end both will work. So I am giving you the option based on your priority. I will also inform our institute about this. So which one you prefer, 3 classes in a week or 2 classes in a week? 2 classes means we will increase the hours to 3 hours, 7 to 10 it will be. So what you want, you just inform me now or next week, just inform. Okay, so yeah, thank you guys. As of now, like we will next class we will continue with the remaining. Okay, thanks. Hi. Okay. Yeah guys, done guys, thanks, bye.
Kamu udah mau cari jamu. Kan, makan udah pada kayak gitu.